So, second. Screen.
Yep, perfect.
Can everybody see that?
Yep. Yep.
As clearly as possible. Okay, perfect. Okay, we'll kick off. Hopefully I'll make the next hour of your time as useful as possible and give you some real insights into the what's happening in the economy. There is a lot of noise obviously out there, and it's becoming more and more confusing for people to really understand what's happening in our economy. The big topic everybody has is interest rates. I'll talk about that. And what impact all of this is actually having on the property market. I do like to make predictions, so I will make some predictions again today. And last but not least, and I don't normally do this, but we're very excited about a great opportunity that's come our way. And we would like to share that with you as well in the last 5 minutes or so. And then we'll leave sufficient time for questions. I'm sure most of you listening today would have some burning questions. And hopefully we could answer those or at least take them offline. My background, those of you who haven't seen me or heard me before, my background has been mostly in banking. You can see the bullet points there. I've had a lot to do with, so ex-CFO of HSBC Bank, spent a lot of time with organizations like APRA, RBA, ASIC, all of the regulators. I've been on a lot of committees, Australian Financial Markets Association, Australian Treasury Operations Association, and been in committees which were sort of leading committees introducing new things into our market. So hopefully with all my background and experience, I can give you some real insights of what I think is happening in the market. And hopefully you'll benefit out of that in terms of making decisions when it comes to buying a property or increasing your portfolio. Okay, without further ado, what are the key things that actually move the needle when it comes to property prices? Okay, so this is in some sort of order. So the first one that I have, and this is true for just about every commodity, supply versus demand. Supply and demand is always paramount, and you saw that through COVID with other products like cars. If car parts were not there, the cars were getting more expensive. Secondhand cars started getting more expensive. Supply and demand is always extremely, extremely important. And what we are seeing in the property market right now is that there is very little supply, and the supply is actually dwindling compared to the demand, okay? And some of that supply of existing properties, people are not putting it on the market, and they're waiting for better times. So from the demand side, we know that's increasing. We'll talk more about the supply and demand in a minute. The second one there is interest rates, because interest rates drives affordability. And what we saw in 2021, in particular, is interest rates went down to record lows of cash rate gone down to 0.1. And we found that, people could afford a lot more. So where people could afford, say, 700,000 in terms of the borrowing, suddenly they could afford $1 million and they could buy a bigger size property. So these two factors are very important. The opposite is happening now. So interest rates are going up. Affordability is obviously getting impacted. So number one, number two. Number three is APRA and the RBA have a lot of levers that they can pull in terms of regulating what is happening in the property market. And one of the key things we've seen APRA do recently is they have played with the lending policies and set certain hurdles when they're assessing your ability to pay. So they're actually using a 3% buffer on the current variable rate when they're assessing how much you can actually pay. So they have a number of, as I said, number of levers they can pull, and they're a key player. It is important for us to have a robust property market. It's important that the banks are able to lend and that they have a lot of appetite to lend. If the bank's appetite to lend actually stops, that will have a massive impact on the property market, okay? So it is absolutely key that we have that. The fourth one there, I'm running through this rather quickly. Each of them you could talk for an hour and debate it. The economy and the most important things in the economy are GDP and unemployment. Okay, and you can see inflation is already up here. Wages growth is already up here. And I've used this slide actually for the last 4 years that I've been doing these presentations, but I can tell you that GDP and unemployment, our government has done an extremely good job post-COVID to actually keep the economy growing, and at the same time keeping the unemployment extremely low. So we are at about 3.7 at the moment, which is a good place to be. So, but we got to watch these two numbers very, very closely when we talk about property, and I'll come back to that in a minute. The other one, which has become extremely important, is the government spending, infrastructure, and incentives. We all know about JobKeeper, JobSeeker, and all those things are history now. But the amount of spending that we are doing in terms of infrastructure to keep in check GDP growth, to keep in check unemployment, is absolutely key to make sure we come out strongly out of the COVID period. And then the sixth one there, and a lot of people may not understand this if you haven't been in the banking world, but the word delinquencies and loan write-offs have a big play on the property market and property prices. Okay, what I mean by that is if you haven't paid your housing loan or your investment loan for 1 month and 2 months, you go into what's called a watch list at the bank's risk committee. So there's a watch list that is prepared. Then if you don't pay it for 3 months, then you go on a what's banks call a worry list. Okay, and then the bank starts worrying about it. And then of course you get some nasty letters, and then they take your mortgage, take your house or your investment property, and they do what's called a mortgagee in possession sale. Okay, now a mortgagee in possession sale, you will see some of those in the next 12 months. Okay, there will be some people who are in dire straits and they cannot sustain it. But the majority of the people, and when I say the majority of the people, I'm talking about 95, 98, 99% of the people will always continue to pay their mortgages. Okay, and the reason for that is, and this is my experience, I've been in Australia for 40 years. I've been in risk committees at banks, at 3 different banks. And I've seen a lot of RBA numbers and APRA numbers over the years. And I can tell you that the mortgage delinquency number has and still is extremely, extremely low. Extremely low. We're not even in the 1%, okay? Extremely low. So in the news recently where you've seen that in some suburbs, delinquencies have gone up in Sydney, you know, some of the, I guess, poorer suburbs, okay? So Mount Druitt area, some of the West Sydney suburbs, you know, Fairfield, a few other areas where delinquencies have gone up. But when you see, if it's gone up by 10%, it's 10% on a tiny number. So keep in mind, we're not going to see, and I can tell you, we're not going to see a lot of delinquencies and mortgagee and possession sales when it comes to residential property asset class. Okay. Generally, you find in Australia, people will pay their mortgages. They might not pay their credit cards. They might not pay their personal loan. They might not even pay their car loan, but they will pay their mortgage. The big thing here, and the reason why I'm saying this is going to stay low, is unemployment is very, very low. So if you really needed to save your house, okay, you can go and get a second job, or your partner can go and get a second job with 10 hours, 15 hours, 20 hours a week, because unemployment is really low. Now, if unemployment in this environment was at 7% or 8%, I would say you would see a lot of mortgagee in possession sales, as I saw in 1982, 1983, when we actually, the last time we had a proper recession. There were the numbers, okay? Interest rate was at 17% and unemployment was over 7.5%. So in that type of environment, when you can't go and get a second job, when you can't actually do anything about it, you sometimes have to give up your house. And so the figures that we have around that is very, very strong, which is going to keep this in check. And the governments are doing all the right things, I think, in that straight. The last one there is global factors. So we've got COVID-19 is a recent phenomenon, but all these other ones, and we'll talk more about how the global market can have an impact. And you've all felt it and seen the global market impact mostly through inflation, okay? Mostly through inflation. And inflation has caused interest rates to go up. Every time our government and our treasurer open their prime minister and treasurer open their mouth, they blame offshore things, okay? They say, well, look at what's happening in the UK and the US. We are no different. We're not immune. Partly true, not all of it true, okay? Only 40% of our inflation comes from offshore. The other 60% is local. But I'll talk more about some of these figures in a minute. So what's happened to the housing market in the last 12 months? I haven't refreshed this for February, but the figures for February, so overall, Sydney, you can see annually, we've had a correction, okay? We've had a correction. And you can see all the numbers on the right here on an annual basis. So we've got some stellar performers like Adelaide. Adelaide has actually been up, okay? But in the month of February, it's been the first turnaround, okay? Sydney actually, and I haven't got the numbers here, but Sydney actually had a 0.3 plus. So Sydney actually went up 0.3%. Okay, it's not something to write home about, but it is still a turn in the current environment when every single person out there, particularly the media, is telling you that the property prices are going to crash. Okay, every second day you hear somebody saying, oh, we're going to have a crash this year. If we're going to have a crash this year, how come we had a 0.3% plus in 1 month? Okay, so I want you to keep that on the back of your mind. And I have a graph later on where auction clearance rates have suddenly jumped. It was in the 60s for a long time for Sydney and Melbourne. Suddenly is gone to 70 plus. We've had a 77%, a 74%. So last 3 weeks has been extremely strong. What is causing that? Okay. If it's all doom and gloom, what is causing that? So I want you to keep that on the back of your mind as well. Okay. As we go through this. Now, in the last few days and weeks, so the factors that impact the property market again. On the left, I've got negatives. On the right, I've got positives. Okay, this is not an exhaustive list, but these are some of the important things we need to be aware of that can have an impact. Out of the 7 things I've showed you, some of these are part of that. Reserve Bank interest rates. They've lifted interest rates by another 25 basis points. 3.6 now, what's next? We'll talk about that in a minute. US Fed has increased further, so we're at 4.75. Canada has had a conditional pause at 4.5. Canada is one of the first countries that has had a conditional pause, okay? And our RBA governor, for the first time, a couple of days ago, has said the pause is closed. We are very near a pause. 2 things he said, actually. A pause is closed. And secondly, that these sharp increases we have had now over the last 12 months is going to have a lag impact. We understand that it has a lag impact. New words from the governor. Okay, he recognizes now that people are feeling the pinch, they've done a lot, and it may be very close to a pause. But we'll talk more about that in a minute. US inflation is now around 6.5. It was, keep in mind, it was 9.1 in June 22. And in 6 months, it went from 9.1 to 6.5. That's a pretty decent fall, okay? We have peaked, okay? We have peaked at the end of December. And from here, everybody recognizes, our treasurer, RBA governor, everybody's recognizing we have peaked, and now we are on the way down. How quickly will that come down? We don't know yet, but we'll talk about that. And then this other factor, which is a negative, is this recessionary. Everybody's now suddenly talking about recession. Will we have a recession? What will avoid a recession? In the US, they've already had 2 negative quarters of growth, but they have a FOMC meeting, which decides whether we're going to call it a recession or not. And they so far haven't called it a recession. Okay. So these things are on the left side negatives. On the positive side, We know in New South Wales, the first home buyers can opt for land tax instead of stamp duty, which can be a huge saving for you. And that could have some impact on the property market. We've got a rental crisis, okay? Why is that a positive for the property prices? Because when you've got a rental crisis, it's telling you a story. The story is we don't have many properties and the demand is increasing. When rentals increase, more investors come into the market and more buyers come into the market. So that can drive the property prices up. Unemployment, as I said, is jumped up a little bit. So it's gone up from 3.5 to 3.7. But we've got more Australians in work now than we've ever had before, okay? There's more work for people than there are people at the moment, which is why we need to get more and more people coming into the country, skilled migrants coming into the country. You all know that the migration cap has been lifted. However, our treasurer said recently that this could surge to 300,000 people in 1 year, okay? This year is a big, big, big year for people coming into our country. GDP number just came out for the December quarter. It was below expectations. Annualized rate still pretty strong, okay? Pretty strong. We want that figure, we want the annualized increase to be, the RBA would want it to be somewhere north of 3. So 3 to 3.5 is good. Anything above that is excellent. So that's just some of the negatives and positives. Keep that backdrop in your mind as we go through this. Global events, I did say I had a slide on global events. So I won't go through all of those, but you can see what has happened in 2022. When we came out of recession, we thought, when we came out of COVID, we thought, okay, lockdowns are over. Unemployment's really low. Economy is booming. Everybody's spending money again. Nobody really lost their jobs. So everybody is sort of really happy, okay? So everybody's gone out and spent money like crazy. By spending money like crazy, you've put the inflation level really up. At the same time, when prices have gone up because of some of these other factors, like this war that we had, okay? And so on. So these are some of the things that happened in 2022 that we all know now, and it's history. So I won't dwell on it, but these factors do have an impact, and we've seen that impact already. Now, interest rates. So cash rates. The history, a little bit about history, because if some of you haven't been in this country for more than 5 or 10 years, and I've been here for 41 years, then you may not know where interest rates have come from. So the cash rate, everybody in Australia now knows what the cash rate is. Even our Prime Minister didn't know what it was, okay, a few months ago. But now everybody knows what the cash rate, everybody's focused on the cash rate, okay? In my 40 years, I've never seen so many people in Australia focused on the cash rate. So you're going back to 1990 here. We're going more than 30 years, okay? We've come from 17%, 17.5% down. Big one increase here, down. You can see the 5%. The reason why I have a red line here is that's the average cash rate since 1990. I want all of you to understand this. Average cash rate since 1990 is actually 5%. So you might say, well, what's all the fuss about? We're at 3.65. What's the fuss all about? Okay. So I'll tell you what the fuss is all about. Firstly, just bookmark these increases. 1, 2, this long one here, 3, okay, 4. And then I haven't got the latest one, which is this one here. Okay, this is a more blow up of this. So listen, where does the RBA want the cash rate to be? They want it to be here between 2 and 3. 2.5 ideal. That's this arrow here. Okay, that's where they want it to be. Where are we now? Okay, I haven't done the change here, but it's about here. Okay, it's about 3.6. So if we're at 3.6, the average for the last 32 years is 5%. Why is everybody panicking? I'll tell you why everybody is panicking. 2 main reasons, okay? Firstly, interest rates went to record low. I never thought I'd see a 0.1. That's the first point. The second point is this increase has been very, very sharp. We've never had that sharp an increase over that short a period. ever in our history. Coupled then with the fact that we've had high inflation, and so people are feeling it in their pockets. Okay, it's not just the interest going up, but people got used to this. I call this period here the honeymoon period, where the cash rate went below 1.5. This period is a honeymoon period. The honeymoon period was actually caused by COVID. It's not going to last, right? Honeymoons don't last very long. So this going up was always going to happen. Whether you had inflation or you didn't have inflation, we were going to get to 2.5 anyway. Are we too far above 2.5? No, we're not. No, we're not. Are we going to get any more interest rate increases? Yes, we are. Okay, but I just want everybody to just understand the history, okay, and the fact that we are still in a low interest rate environment. Don't let anybody tell you we're in a high interest rate environment. I paid 17.5% for my first house in Australia. Okay, so I have paid 12%, 14%, 10%, 9%, 8%. I've paid all of those rates before. Now, at these rates, we're still very, very low. So I just want you to understand that, please. The CPI, as I said, is peaked. It's going to be down from here. This graph is only going to come down from here. How quickly it comes down will depend on a number of factors. And then wages growth is the other important thing that the government is looking at. They want to see wages growth controlled. So by more people coming here, you will have a bit more control on the wages growth. You don't want wages growth to go up too fast. What will that do? That'll cause an impact on the CPI, our inflation number. Rentals going up like crazy also causes an impact on the CPI. Okay. Now, interest rates and where to from here. So, I have been predicting, okay, recently that, in fact, I had predicted that it's not going to go up above 3.25, but it has now. And I think based on the Reserve Bank governor's latest speech of a pause, I think there'll be one more in April. The Reserve Bank governor and the board, they are looking for some indications, strong economic indications, strong data that suggests that we are stopping to spend money. Please, everyone listening today, if you want the Reserve Bank to stop increasing interest rates, stop spending. Okay, the message is stop spending. Let retail sales go down. Let GDP go down. The figures need to look really bad at the end of April. If it looks really bad at the end of April, guess what? Then you're not going to get. This is what they're waiting for. They're waiting to see some bad numbers. Okay? So please don't stop spending in the next 12 months. I told the next 2 months. And you will see that they will pause. I mean, that's a fact. They're looking for these indications. Okay? So they want to see the indications that I'm talking about here, retail sales. We're seeing some good signs of shipping costs coming down and other costs coming down. Oil prices, not so much, still up there. And then the recessionary and stagflation issues we're seeing in the Northern Hemisphere countries. This is much worse. Their economy, like UK, is much worse than here. China economy slowed down, self-induced, because they still had a zero tolerance policy on COVID. And then the last one, wages, which I've talked about. Now, on the right side here, so my prediction here very clearly is we're going to see a pause after the next one. Okay, after April, we're going to see a pause. On the right side here, and this is today's graph, is what's called the futures implied yield curve. The futures implied yield curve is what the money market thinks where interest rates are going in the future. That has nothing to do with what the Reserve Bank's cash rate is. The Reserve Bank only sets the cash rate, not the fixed rate. They do not set the fixed rate. Who sets the fixed rate? The money market, which is global markets. So when I was at HSBC, I set the fixed rates for HSBC, okay? And those fixed rates are the fixed rates that we draw a yield curve every day, and then we work out how much margin we're going to make on housing loans, and we set the rate fixed for 1 year, 2 year, 3 year, 4 year. Every single day, the bank's money market area actually does that using the futures curve, using the bond market, and using what's called the interest rate swap market. Today is not a day to talk too much about that, but I just want to show you this graph because they think the peak is at 4, around just above 4 here. And then there is a falling market sort of throughout the early part of 2024. Now, however, if we see those bad numbers at the end of April, and if we see the RBA actually pausing, which I'm pretty sure that they will do after this next increase in early April, so from May, no further increases. As soon as that happens, guess what the money market will do? The money market will start predicting a fall in interest rates. And instead of, I can actually, when the time does come, I will show you a comparative of this graph, and I can assure you that from like second half of this year, this will start tapering down like that. And you'll see it coming down by middle of next year down to about below 3. So they react really fast. So you remember when variable rates were 2.7, 2.8, fixed rates actually went down to 2%. Why? Because fixed rates are not set by the RBA. They are predicting where it's going to go. Did we go to 2%? No, we didn't. We stopped at about 2.5% at variable rates. Okay. So the fixed market, you will find, is going to move really fast when they think we have peaked. Very, very fast. And one of my predictions is that in the second half of this year, sometime probably in the fourth quarter of this year, you are going to see the fixed rates well below the variable rates. Okay. So if let's say the variable rates at the fourth quarter of this year are at 5.8, you will probably see fixed rates at 4.8. So if anybody listening to me today is thinking, oh my God, I better fix now because the media is telling me this thing is never going to stop. Well, don't listen to the media, okay? And don't listen to the Reserve Bank governor anymore because nobody trusts him anymore. Okay, I'm trusting him on this one, but generally speaking, people don't trust him anymore. He's under a lot of pressure to resign, actually. He's under pressure from the government and the public. But it's important for them to pause to see the impact, the lag impact of the bad numbers coming out, because they will always lag 3, 4, 5 months after such tightening that we have done, okay? Now, I told you to bookmark those increases we had in the past. So everybody's telling you, and they said the same thing in 2020. 2020, everybody was saying, middle of 2020, we're 6 months into COVID, 5 months into COVID. Everybody's saying 20% fall, 30% fall. You all know that. All the banks were wrong. I came out and wrote an article in the paper and I said, we are going to be 20 to 25% up in 2021. I wrote that in July 2020. And people rang me and abused me and said, are you stupid? I had good reasons. I had 7 good reasons why I did not think that there would be delinquencies and mortgage in possession sales. That's what causes a crash. A crash is caused by, you have hundreds and hundreds and hundreds of mortgage in possession sales where the bank is trying to just take their money. They've got an 80% LVR. They take the money, okay, and give you whatever's left, and they just want to recover their debt. And nobody comes to the auction. Nobody comes to the auction. That's when you see a crash, okay? That is when you see a crash. People who talk about crash in a blasé fashion, they have no idea. So I'll have you have a look at this. So we had a 2.75% increase in the cash rate in that period. What happened to house prices after December 1994? What happened to house prices? It went up 0.3%. 2 years after the last hike, 2%. 5 years after the last hike, 26% up. And I'll let you see the other numbers. I mean, this is massive, right? There's some of these massive numbers, 1.5% increase, 3% increase here. So this 1, 2, 3, 4 tightenings happened in the period. Now we've got the fifth one. We've got 3.5% up already. So at 0.1, so it's 0.1 it was, now it's 3.5 up, it's 3.6. So this we will fill up over the years, okay? And I can assure you, I can assure all of you, there is no crash happening here, okay? The people who talk about a crash have no idea what they're talking about. Yes, some people are going to feel really tight, very tight budgets already and in the coming year. They're going to do it tough in this year. Okay, some people. What percentage of the people? Very small. We're not talking 10%. We're talking less than 10%. The other people will manage. Okay, the other people will manage. So I don't expect a crash. I don't expect property prices to crash. You've had a +3 February, plus 0.3. You might see it pretty flat over the next few months, but as soon as they pause, and that's not too far away based on my prediction, if they pause, you're going to see a lot of people who are sitting on the fence waiting for the market to bottom come back into the market. Okay, and that's going to cause a small spike. We're not going to see a 2021 again. Okay, that only happened 3 times in the last 100 years. You're not going to see 25, 30, 40, 50% jump in property prices. So you are going to see a moderating market slowly picking up in the second half of this year. That is my prediction. So what's happening to Sydney? Very, very quickly, again, conscious of time and not going over time. What's happening in Sydney has not changed. These are New South Wales Treasury numbers, has not changed. By 2036, we're going to have 2.7 million people, okay? Sorry, we're going to have 6 million people in 2036. By 2054, we're going to have 8 million people. We need to cater for this type of growth. We need 40,000 dwellings per year. Okay, so that's based on about 100,000 people coming into Sydney every year. So if 100,000 people come here, okay, then you're going to need 40,000 dwellings. So this is massive. Okay, this is massive. Now you're already seeing how much infrastructure changes are going on. This is twice in a 100-year infrastructure change that's happening to our city. And to be honest, it's also happening in Melbourne. But I've never seen so many tunnels being built. I have never seen so many hospitals getting revamped, new hospitals getting built, schools getting upgraded, universities getting upgraded, a new airport being built. It's happening everywhere. Metros, roads, tunnels, it's going through a transformation. Our city is being transformed. Why? Because we've got to cater for that many people. We've got to cater for that many people. That hasn't changed. And guess what? We paused for 2 years. So now this is a tsunami effect at the moment of number of people coming this year, next year is a tsunami effect because we had the backlog. So suddenly there's no more properties left. I know people used to say last year, oh, apartments, the apartments are empty. Okay, in Melbourne, so many apartments were empty. In Brisbane CBD, there were apartments empty. Now I'm telling you, there will be nothing empty. Okay, this is the worst and the most chronic rental crisis you will have seen in your lifetime. I haven't seen it for 40 years. I'm telling you, what we're going to see in the next 12 months is going to be the worst time ever. So I call this the perfect storm for apartments. Why? Apartments are due for a rise to bridge the gap with houses. During COVID, and I'll show you a graph in a minute, during COVID, house prices went up a lot more than apartment prices, okay? And there's a very simple reason for that. Migrants were not coming, students were not coming, and the people who were buying houses could afford houses. They were living in apartments, but then suddenly instead of buying apartments, they thought I can buy a house now. So apartments were not in vogue. All those things have changed now. We've got migration happening. Expatriates are returning. Students are coming in big numbers, okay? The demand for rentals and from investors, investors are going to come in because high rentals and rental demand. And there's a lot more foreigners who are buying properties here now. A lot more foreigners coming even from North America and Canada. So this is supply and demand. You saw my first graph, supply and demand. Demand is coming from all these areas. It's not a short-term phenomenon. This is going to continue to happen for the next 3 to 5 years. Massive. Supply on the other side is significantly down. So one graph is going up, the other's going down. And I want to actually show you this, right? I want to actually show you this in a minute in a graph. So rentals are heading up and up, chronic shortage of properties, the affordability issues with houses. So people's affordability issue, they'll go, oh, I needed to buy a house, but hang on, I can't afford a house, but I need to buy a property, so I'm going to just buy an apartment. So that whole dynamic that happened through COVID, 2021, is now the opposite. And we are finding that a lot more people are changing to apartments for lifestyle change. They want convenience. They want to live next to a metro. They want to live next to a train station. They want to be convenience. They want to walk to the coffee shop, all those type of things, okay? And there's more downsizes coming into the market now. We're seeing a lot of people looking for large apartments to downsize. This one I've talked about, so I won't go through it again. But I just want to make the point that if those of you first home buyers listening today, if you don't know the difference, the land tax is only on the land value. So when you buy a house and land package, the land component can be 50 to 60% of your total purchase price. So you pay on, say, $1 million house and land package, you pay on 500,000 roughly on the land. It's actually much more than that in Sydney, but just to give you an example, you buy an apartment for, say, 600,000 or 700,000. The land component of the apartment is normally only about 100,000. So your land tax on the apartment is very, very small. And listen, we can demonstrate that to you because the calculators are online. And then we have a low unemployment environment. So trust me, unemployment is going to go up. Okay, it's going to go to probably in the next 12 months. I can see it going into the mid 4s, but that's still low. We were at 5.2 before COVID. Okay. And so unemployment is not an issue. And we've got huge infrastructure spend. This is the graph that shows in Sydney, this is apartments, this is houses. Houses overall outstripped apartment price increases. And that happened in Melbourne, that happened everywhere actually, okay? Pretty much. The other thing I want to tell you is that this gap that has been created between house and units, a lot of people say to me, and I've had a lot of people who've been in this country only for 3 or 4 years, they said, but apartment prices never go up. The fact is, they move in tandem, okay? This is for 30 years here. They move in tandem. You can see when it goes down, goes up. Okay, this is the prices. So apartment prices, of course, are lower, okay? But the point is, this gap here that has been created, this gap will narrow. This gap will narrow not because house prices will fall, but because apartment prices over time will catch up, will be a steeper increase in apartment prices growth than house prices in the next 3 years. And I can guarantee you that, okay? You can hold me to that. This is regional, this is major cities. But I saw, and then the trend, the long-term trend in property here, and that's why you got to keep buying properties in Australia. The long-term trend is it just keeps going up and up and up, okay? Now, this is probably the most important graph I'm going to show you today. The point I've already made that the apartment starts in 2021. It takes 3 to 4 years to build an apartment. You get your DA approved, you got the site, you do the DA approved, you go through the process, and it's a lengthy process. It takes 3 to 4 years. Now, the starts in 2021 was the lowest. You saw the numbers. It was the lowest, okay? I'm going to bring it up again. I'm going to bring it up again just to show you. Oops, gone too far. My apologies. Here. 8,800 apartment commencements in Sydney in 2021, down 70% from the peak in 2016. Nobody's talking about this. Nobody's talking about. People talk after the fact. I've been telling people for 1.5 years, we're going to get a rental crisis in this country. Go and fix your rental lease for 2 to 3 years at today's rent. And those that listened are thanking me. But the media talks after the event. So the point here is these are completed apartments. 2022, we're going to get 14,000 completed apartments in Sydney. Melbourne's the same trajectory, but Sydney's steeper. 2023, where we are now, only 9,600 apartments will complete in Sydney, completed apartments. And 2024, have a look at this, 4,500 only. And that's because of 2021. Okay, the starts in 2021 were so low that it's going to cause a chronic period here. Nobody's telling you about this, but we're seeing it in the rental market. We're seeing it in the rental market. And you're going to see more of this. People are going to start talking about this now. And a lot of developers, a lot of apartment developers, you've seen a lot of house builders, they have gone down in this period because of the rising cost and they were not able to sustain it. Okay, that's another reason. The rising costs have been a major issue. If everything stands still and the costs go up 25%, guess what? Your apartment price goes up 25%. If everything else stands still. So keep that on the back of your mind too. Once the developers are used to a higher price for their apartments, they're not going to bring it down, even though the cost of raw materials and labor cost may go down. Okay. So this is very important graph that I want to share with you, and I want you to be very mindful of. So demand during this period is actually going up. Supply is actually coming down. Okay. So what's happening to rentals? 19.2% increase in Sydney in the last 12 months. That's massive. And you know what's going to happen in the next 12 months? I am predicting another 15 to 20% increase in rentals. So some of my listeners, I know there's a couple of them there that live in Wentworth Point. Wentworth Point overnight, as your lease comes for renewal, people who are paying $600, $620 a week for 2-bedroom apartments suddenly are paying $720 to $740. And it's almost like it's going up weekly. Okay. So this is happening all over Australia. Okay. This is happening all over Australia. And we've got chronic shortage now. You just have to have a look at the rental vacancies here. National level, 0.8. Now, Sydney is at 0.9. The lowest is Perth and Adelaide. This is chronic levels. Okay. We're already seeing parts of Sydney where, you know, things are going absolutely berserk. Okay. Now, if you look back at this, you see that the top panel here is actually houses, and the bottom panel here is actually apartments. So apartments are actually, you see these percentages here, apartments are actually going up rental higher than the houses.
Yeah.
Okay, that is an important point to know. Now, I can see that the 0.9, and then for Melbourne, those of you who are from Melbourne, these numbers are only going to go lower because you cannot solve this issue overnight. The people are coming into this country, whether they're on working visas, students, or migrants, they all need a place to live. So this will only go down. If it goes down below 5%, we have never seen that for a very, very, very long time. Okay, certainly not in the last 41 years I've been here. So this very simple graph here to illustrate the point. Are we going to continue to see economic growth? Yes. Jobs growth? Yes. Wages growth? Yes. Population growth? Yes. If these things happen, it's very simple. You're going to get increased rental and buyer demand. That's going to push up rental prices and property values. Okay. That's going to be the story in Sydney and for Melbourne for the next 5, 10, 15, 20 years. This thing is going to keep going. A few things here in terms of key considerations when buying a property. Whenever you look to invest in a property, whether it's to live or if you're looking for capital growth as an investor, you've got to look at infrastructure. Location, 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 yes, but location's number one, but it's not the only thing, okay? You've got to pay the right price for the property. I have a lot of people who've paid the wrong price for a property. I can give you a number of examples, and we talk people out of this all the time. So people have bought 2-bedroom apartments in Rhodes and in Wentworth Point for prices like $950, $1 million, $1.1 million for a 2-bedroom apartment. Okay. And they've been wondering why in the last 3 years they haven't seen any capital growth. They bought it at the wrong price. You've got to pick the right location. Is Rhodes a good location? Absolutely. But if you're looking for capital growth, you are better off buying a block of land in Tallawong in Rose Hill 3 years ago for $500,000, and now it's worth $1 million. Okay. Timing is very important. Timing is crucial, actually. So, and who the developer and builder is very important. So these four factors are very important when you're buying a property. Now, I am going to show you an opportunity today. As I said, I don't normally do this, but I believe in showing something when I know I'm going to buy somewhere myself. If I'm not going to buy in a development myself, or in a location myself, or in a project myself, I'm not going to recommend it to you. And that is just the ethics in which Nivas actually works. Okay. So I won't go through each of these points here, but you can see that the northwest of Sydney is going to have, and west of Sydney is going to have so much of infrastructure, so much of jobs growth, so much of population growth. The northwest precinct will be bigger than Canberra in 8 years' time. Okay. This is massive population growth that is happening. And keep in mind that GDP just for New South Wales is actually bigger than these countries, okay? Malaysia, Singapore, Hong Kong. And Greater Western Sydney is the third largest economy in Australia. So these factors are important when you're looking at where should I invest my money? Okay, I know there's a lot of people who made money buying regional properties. Listen, it is not on my list. It's not on my list. Population growth for me is key, absolutely key. Okay, and I said I'll show you the auction clearance rates in each of the cities. So this was a little bit lower than the week before. So you can see, you know, this Saturday last year. This is last year at the same time. This is a couple of weeks ago, and this is last week. Now, these figures are really strong numbers, and it jumped overnight. So listen, I won't dwell on this one. These are some of my predictions. I've already mentioned in mid-2020, I predicted a 20% jump in 21. If anybody's interested in the article, I'm happy to share. I predicted into middle of 2021 that interest rate will start rising in July 22. And I told everybody at that time to go fix their rates. Fix it as far out as you can. Don't believe the Reserve Bank governor. And a lot of people are thanking me today because there is no way in the world that you're going to have 0.1 cash rate for a sustained period of time. The guy's got to have rocks in his head if he's the Reserve Bank governor. I can tell you intuitively that that was a honeymoon period because of COVID. Of course, it's not going to last. How can it last for 4 years? Right? Makes no sense. So I told everybody to go fix their rates. And that was both these things are just a no-brainer. We know, you saw the graph on the property. You can't go and increase your density overnight and create all these properties. Okay, so when you got heaps of people coming after COVID, when you had a pause for 2 years, of course you're going to get a rental crisis, and that's why I was telling people in 2021 you're going to have a major crisis. It's not rocket science, guys. Very quickly, my key economic predictions before I spend 5 minutes on the project. For the next 12 months, I expect RBA will increase cash rates by 25 in March. This has already happened. So this is my last graph. And April, and then it'll peak, okay? Inflation will fall to 6% by June, 4% by December, and 3% by June 24. Retail sales, I reckon, will fall. Will fall in January's figure was actually up, but there were a lot of sectors that had a fall, like Harvey Norman is a good example. They had a fall in sales. GDP will slow in this first quarter and second quarter, so the numbers are not going to be good. But we're going to avoid a recession. We're going to have a soft landing and avoid a recession because we got a lot of migrants and visitors coming here, and they have to spend money. And consumer confidence will go back up again in the second half of the year. RBA will cut rates between September and December this year, and I'm not predicting next year. I'm predicting this year because of the negative quarter I think will happen in the third quarter. Fixed rates is very important. Fixed rates are going to start coming off as soon as they think Reserve Bank is done and dusted. No more inflation going up. Everything start to correct, moving the right way. So fixed rates are going to fall really fast. If anybody listening to me wants to fix their rates, don't go and do it now. Please wait until the second half of this year. In fact, as late as this year as possible. but you are going to see the fixed rates fall in the second half of this year. Unemployment, as I said, is going to increase, and that's still healthy. Okay, it's not at 7% or 7.5% or 8%. Now I want to very quickly talk about this project, and I'll go through it really quickly so we can take some questions. The reason why I'm showing you this project, and we literally got this project given to us as an agent in the last couple of days. And it is an exciting project. It is a high quality project. It's in the northwest of Sydney. So that's the address. The apartments and townhouses within the same complex. The builder is Binar Group. The architect, Rothelman, is one of the most renowned architects. Please go Google them and see what they have designed before. The developer is Denville Group. They have been around for 30 years. They are a very cashed up group, so chances of them going down very slim. They bought the whole land. The whole land was bought in cash by them at some time ago. They've been land banking in some very premier places in Sydney. This is not a high rise. It's a 6 level with 1.5 level of car parking. The project is starting in 2 weeks' time. Binar, the builder, is a reputed builder. We, as an agent, have sold Binar properties before in Sydney. This one's in Liverpool. This one's Western Sydney University. This is the atrium near the Georges River. So they're a quality builder. Now, you will see one thing in this project which is very unique. It's called Babylon for a reason. It is built by that historic Babylon, and you're going to get that Babylon feeling with the water flowing, with the fountains and the seating areas. It's going to be a very serene type atmosphere within the complex. Okay, so this guy is Mike Horn, and I don't profess to know him, but I am told he is one of the best landscape designers that they have hired. This is some of the projects that he has worked on that they have hired to actually look at this project. Now, and you'll see in a minute what I mean by the difference, the differentiating factors in this development compared to the others. This is where the site is, okay? So Rouse Hill Shopping Center is all over here. It's a massive shopping center. They're going to expand the shopping center and make it 1.5 times its current size. The new hospital in the northwest, there is no, except for a very tiny hospital called Norwest Private. It's private, not public. There is no other hospital to cater for the growth in the northwest. The fastest growing population in probably all of Australia is in the northwest of Sydney, okay? So all these areas, Rouse Hill, Box Hill, Riverstone, Marsden Park, Schofields, they're all the new areas. Now, this is where the new hospital is going to be. So you basically are here, you're walking here, and you walk to the hospital. So if you're a doctor or a nurse, absolutely perfect location. The metro is here. The Rouse Hill metro is actually here, okay? The Tallawong metro is here. So it's actually very well positioned. Transport, hospital, new educational institutions, new schools, they're all within close proximity. Now, a few very quick things. So we've had a huge investment in metros. I don't have to dwell on that. There's currently more than 56,000 people employed in the Hills district. This figure is only going up. I've talked about the growth in the population to 250,000, okay? The Rouse Hill Shopping Center is getting a $300 million injection. There'll be more than 240 stores there, okay? There's $3 billion plan to revamp Norwest Business Park. Norwest Business Park is going to be the biggest business park in Australia, okay? So, and then this hospital, firstly 300, and then further expansion, another 400 million been earmarked for this. So all these are ticks the boxes, okay? I said about landscaping, and I said it's going to look different. Well, here's a couple of very quick pictures for you as to what it'll look like. It's not a swimming pool, by the way. It's no swimming pools, no gymnasiums in this to keep the strata low. Now, it's a unique development because you've got 3 different types of layouts, okay? lots of different layouts, I should say 3 different types of properties. One is sky terraces and residences. So these ones have their own sky terrace on the top. You see that in a minute. And then the middle ones are like a normal apartment. Your normal apartment is called residences. And then the third one here is what they call courtyard or garden terrace or pavilion. And they are also 2 levels. Okay, so you've got your own little courtyard. This will illustrate it better. This one's more a public rooftop garden. So that's not what I'm talking about. You're not gonna get something that big on top of your apartment, but it's a place where the everybody can use. Now the quality of this is going to be, in my view, in the northwest of Sydney, the quality of this that I have seen is going to be better than anything I have seen. So these are timber floors. You've got marble bench tops. You've got marble bench tops in your kitchen, marble splashback, Miele appliances, okay, marble in your bathroom as well, LED lighting, everything. So your carpets are wool carpets, plush wool carpets. So they have 2.7 meter ceilings. You've got ducted air conditioning throughout. In quality, they have not compromised at all. Okay, this is what a courtyard apartment looks like. So you got your apartment there, you come out into your own courtyard. This furniture obviously is not included in that. Okay, but the quality will be absolutely outstanding. This is what a rooftop garden for your apartment, those that go for those double ones, will look like. Okay, very, very different. This development will stand out from the crowd. Everybody buys apartments, but they don't buy apartments like this. The beauty of this, though, is coming in a minute, okay, is the pricing. So I'll talk about pricing in 1 second. But example of a layout, this is a internal 71, external over 70 as well. So you've got bedroom, living areas, little terrace here, and then you go steps up to your own roof terrace. That's one example. There are a lot of different layouts, by the way. Here you've got again a double-story layout, 2 bedrooms with a courtyard, okay, and another little courtyard there. Here's another roof terrace one, 1 bedroom with a roof terrace. You've got a terrace here with a spiral steps going into your own roof garden. Okay, a lot of different layouts. And here's another one, which is a 1-bedder with a terrace. Okay, so a lot of different layouts. But the important thing here is that this developer has come to us, and I'm not ashamed to actually point out the 4th bullet point here. There are 2 agents, only 2 agents attached to this project, Nivas. And he was very clear. He said, I've got 1 Indian agent and 1 Chinese agent. Okay, a lot of buyers in this area, if you're not familiar with it, actually come from those backgrounds. So there is 1 other agent on this project. Okay, they are actually giving extremely competitive prices. There is no 1 bedroom. There is no 1 bedroom in Rouse Hill, a brand new for $499. Go and do your Google search. There's no 2 bedrooms in Rouse Hill at $629. Okay, they're giving a 5% rebate on prices. Now the double-story rooftop, they start from about $740. Well, $740. Some people are just selling a normal 2-bedroom apartment in this suburb. Okay, no rooftop garden. No quality finishes. So why are we excited about this? Remember I said, you've got to buy in an area with growth. You've got to buy below market value. You've got to buy wholesale prices, right? They're giving a 5% rebate, not for long. When did these prices come out? Today. It's a coincidence, okay? It wasn't planned like that. This seminar wasn't planned like that. But these prices came out today, and when we saw it, we were actually shocked. And they said, but there's a big proviso here, but the 5% rebate, so if you're buying some double-story with your rooftop garden for $740, you take 5% off. You're down to $710, $715. You can't buy those stocks.
833.
So the point I'm making is these rebates are going to go extremely, extremely quickly. As soon as they've sold a number of, as soon as they've sold maybe the first 30 or 40, they're going to stop it. Okay, there's about over 300 apartments in this complex. So this is an opportunity. This is what I call wholesale prices. Buying smart, buying something in that 600 with a 6 in front of it. Well, you only have to come to Castle Hill and everything's 9 in front of it. Castle Hill, come to Norwest. Norwest is only, 2 train stops from here, metro stops. It's only like 5 kilometers. So you can see what price you're buying at, what growth is happening there. Hospitals coming up walking distance. The hospital will start actually next month. So, and they'll finish around the same time as this project, which is end of next year. So you pay your 10% now, and you're buying a very, very, very quality product. And you just wait until end of next year. And, I don't give guarantees like this. I don't say these things normally, but I can assure you, you're going to get a price increase. Even the rebate is a 5% price increase. Okay. So you're going to see a price increase. It is a great opportunity. There is no question in my mind that over the coming years, if you're building a portfolio, this is a perfect time to buy a property like this. Okay. So I would urge you to register your interest now, because we are not selling alone in this. If you go to another agent, no one can reduce the price like another $1. Okay, so don't think you're going to get a better price elsewhere, but we can help you, and we always do. We've got very good rapport with the developer, Krish, who's listening in this.
Yep.
He knows the developer personally. And he was the first person the developer called and said, I want you to sell my project. Okay, we have got a good name. And so if there's few things to negotiate, not price, a few things to negotiate for you, we're in a good position to actually do that for you. Okay, and I really mean that. Low strata and good rental returns. So you can see strata, 1 bedroom, this is probably for a studio. But there's 1 bedroom still very low, 2 bedrooms still very low, and they've kept it low, 3 bedrooms still very low. They've kept it low because they don't want a gymnasium, they don't want a swimming pool, they don't want all of those other things to increase your strata cost. Rentals are going to be very strong because this will be a prestige, standout development. And these are rentals from today, okay? I'm telling you, end of next year, the rentals will have gone up another 15 to 20% more from where we are now. So excellent return, lock in a price cannot go up, and you can just pay your 10% and watch the price grow. That's why I'm showing this to you. We are excited about this. When the rebates go, you got a 5% move already. So I would really urge you to look at this if you are looking for this type of investment or a place to live. Okay. In concluding comments, and I know I've already gone over time, please don't follow the media blindly. Okay. You all know that lesson already if you've been here through COVID. Do your due diligence and speak to experts. Have a long-term view when building a portfolio. Everyone listening today, if you're a professional, some of you listening may be on a salary of 120, 150 or more. Your partner might be on a similar salary. There's no reason in the world why you can't accumulate a portfolio, a good portfolio of 15 to 20 properties, okay, by the time you retire. There is no reason why. If you think that you can't, then you need to talk to us, because I know it can be done. I've done it, okay? So it can be done. And when you see a good opportunity, that's when you grab it. The downside risk in something like this is 0. Okay. Australians became the richest per capita population in the world for a reason. They invested in property. We've gone past Switzerland as the most affluent and highest wealth per capita population in the world. We've gone past Japan, we've gone past Switzerland. And the reason for that is property, and property values will keep increasing here. Okay. I'll stop there and take some questions. I apologize for going over time. There's some contact details there, and there are, of course, obviously other people that may have invited you. I'll stop there and take questions, and thanks for listening again.
Thanks for that, Sachin. Appreciate it. Okay, we've got one question to kick off from Nathik. So he's written, I believe land appreciates in value and construction depreciates. So for a unit, if the gap is going to narrow, for unit prices to go up, it means land prices will go up as well. But if that's the case, because a house has more land, wouldn't the house price go up more? I mean, yeah, wouldn't the house price also go up?
Listen, I respect the logic, and you are extremely correct in what you are saying, in that it's the land value that generally goes up. Yep. So that is absolutely right. The land value is what actually goes up. Generally speaking, in the last 40 years, I have not seen such a spike in the cost of construction of property. Okay, I've not seen such a spike. That spike has happened, and I talk to developers every single week. Actually, apartment developers, I talk to them, and I can tell you that, and I'm on a lot of their advisory boards as well. I can tell you that a two-bedroom apartment to build in Sydney was costing around the 250 to 280. Now that price is nearly 350 to 380. And in this project, we spoke to the developer this morning, in this project, it's actually higher than 400,000. Okay. So the reason why this is not as expensive as you would expect is because they bought the land really cheap. Okay. This is a prestige project. They want to make this an excellent project, and rest assured that the prices will go up. By the time we are in the stage 3 of selling, the prices are going to go up. There's no question about that. But to your point, apartment prices have suffered. They have been depressed. And so there is catching up to do. That catching up is going to happen rather quickly. Okay. The return that you get on an apartment is significantly more than the return you get on a house, because the rentals on houses don't go up as much as apartments. And now with the shortage of properties, that gap has to narrow. So if you look at the last 40 years, 30 of those 40 years, it's moved in tandem. It's more particularly in the last 3 to 4 years where that gap has widened, and it needs to close. Okay, so I'm not saying land values are not going to go up. Land values have actually come down quite significantly in a lot of parts of Sydney because of the big increase we saw in 2021. So we saw some places went up 70, 80%, and now it's down about 10 to 15%. So that's already happened. But all I'm saying is apartment values is going to go up. So if you've seen apartments which haven't done much for the last 3 years, and they're around $700,000, you expect them to very quickly jump to $800,000. That increase in apartment value is going to go up quickly. Okay.
All right. Thanks for that, Sachin. Awesome. Okay, we've got a question from Ed. Now, when will stage 3 kick in, and what do you expect to be growth by then?
Well, I'm sorry, say that again, Krish. Sorry.
He was just asking when will stage 3 kick in, and what do you expect the growth to be by then?
Okay. Listen, we've only just sort of got into this sales program. We think there's going to be at these prices. There's going to be a lot of movement over the coming weeks. So it's going to be a case of first in, best dressed. And I'm not putting pressure on anybody. This is just we were there this morning at the display, and there was a lot of activity already happening. People were signing contracts already. So I cannot tell you what would happen in stage 3, but all I can tell you is that at these prices, and we have been selling other projects in Rouse Hill. And these are priced a good 50 to 60,000 below that at the moment. Okay, and so it just goes without saying that when your 5% rebate goes, you would have gained your 5% already. By the time we get to that stage 2, stage 3, the developer is not looking for money to build this. They have got the cash to build this. Okay, so but you expect that because they are relaunching this project, they're going to get some sales, get some early wins, and then slowly the prices will creep up. Where it's going to end up, I don't know, but I would say somewhere in that 5 to 10% range. So 5% rebate goes, you could see another 5% jump in price for the last 10% of the properties.
Yeah. And just to add to that, so we'll be selling stage 1 and 2 for the moment. Then stage 3 will be coming in the next couple of, whenever we exhaust the current allocation. But all 3 stages will complete at the same time next year. So thanks for your question, Ed. Now we've got one from Vinu. Okay. Hi, how will capital growth be if we invest in a property of a small area in a well-developed area?
I'm sorry, I didn't get that question.
That's okay. So, hi, how will capital growth be if we invest in a property of small area in a well-developed area? Vinu, if you're there, perhaps you might be able to elaborate on that.
Yeah, please. Is he on mute, Krish? Have you muted?
Everyone's on mute, yeah. So if you're on mute, Vinu, you might just have to unmute. I'll have a look and see if you're here actually.
Hi, yes.
Hey, Vinu. How are you?
Hi. Yeah, good, thank you.
Good.
So I was just asking, is it a good idea to invest in a well-developed location? I mean, it would be pretty expensive, but in case if we come across a property of even a very small area, so is it a good idea to invest in?
You mean an established suburb, something with
right. Yeah.
Okay, cool.
So, Vinu, I think and a very good question. Thank you. So in an established area, you would be paying a premium for sure. Because there is, in an established area, generally there is not much more stock that's going to hit the market. And people want to live closer to the city. So there is a lot of suburbs that, we can name where prices are at what I would say, not so much at a premium, but it's definitely on the high side. So you could be paying 1.5 million in some suburbs in Sydney for a 2-bedroom apartment. So then you've got to say, well, how much is that going to grow vis-a-vis you're getting something below market here, a brand new property in a high growth suburb. There's a lot of boxes that we ticked in terms of hospital coming, shopping center getting expanded, etc., etc. That metro, I forgot to mention, is going to go all the way to the new airport. So another 6 stops from there will be the new airport. So you'd be at the new airport from that metro in about 20 minutes. Okay. So all this infrastructure bodes well for the growth in price of this location and this project. I mean, that's probably the best way to answer it. So the chances of, and don't quote me on this, but the chances of this property going up to $950 to $1 million is a lot stronger than the 1.51 going to 2.2 million. In percentage terms, I'm talking percentage terms, right? So you got to look at percentage terms. So you're going to see, if you can see a 30-40% jump, there's more likelihood of that growth happening in a growth suburb than in an established area. But that's not to say that that established area will not go up in value as well. It depends on your price point. If you are wanting to live somewhere or you are doing an investment and building a portfolio, it depends on a number of things, your personal circumstances, really. One of the things that's happening in Sydney a lot now is what's called rent vesting. People are renting in a suburb where they want to live. Like I know one of my nephews is actually renting near the city because he can actually walk over the bridge and get to work. And he likes to do that, but he's invested in Rouse Hill. Mm-hmm. So rent vesting is you invest where you can afford and you rent where you want to live. That is becoming a new phenomenon as well. But good question. I hope I've answered that in a roundabout way.
Thanks, Vinu. Okay, next question. As the construction cost increased already a lot over the last couple of years, do you think construction costs will continue to rise or increase again?
I don't think so. I think most of the construction cost increase is done, and it has been very, very steep over the last 18 months. Okay, and it's not just the raw material cost; it's also the labor cost. Now, the labor cost, we all know that getting any skilled labor in the building trade is very, very costly now, and they charge a premium. From whether it's a brickworker, electrician, plumber, everybody's charging a lot. Now, I think with a lot more skilled migration coming into the country, there will be a little bit of pressure on that rates to actually come off a bit. As far as raw materials go, I think the shipping costs have actually come down. Some of the issues that we had have actually come off. So not everything, you know. I'm told the price of timber and cement is still pretty high, and they're causing the prices to be high. But listen, most of the home builders and apartment builders have now factored that in. Talking to most of them now, they're not budgeting for any further increases. And it was a phenomenon partly related to the war, partly related to COVID and the supply chain issues, but a lot of them is sort of smoothed out now.
Awesome. Thanks for that, Sachin. All right. That's the last question on the chat. Any other questions, everybody? Please feel free. No such thing as a silly one.
So I hope everyone enjoyed the session. We got some further insights into what may be really happening rather than just listening to the media. And you know, not all is broken in the housing market, and you will find that when things turn, they turn extremely quickly. In the same way that you saw the auction figures. And the same way, you know, once the Reserve Bank governor says we are pausing, you will find fixed rates are going to start falling. So, do not believe people who tell you that, you know, cash rate is going to 5% and 6%. It's not going to happen. Okay. Okay. Thank you for listening. And if anybody wants to take the great opportunity that we have at the moment, and it's not going to last very long. Please contact us, because we are excited. We want all our close family and friends to actually look at this as well. So thanks again for listening. And unless there's any further questions.
Yeah. Thank you, everybody. And if you just wanted to go back to anybody who invited, wherever you saw the post, they'll be able to provide you with more information on the project, or even if you just want to sit down and have a chat with us anytime.
Thank you all. Have a good evening.
Thanks, everyone.
Thanks, everyone. Thanks, everyone, for joining in.
Thanks, Raj.
Ciao. Ciao, guys. Thanks, Sachin.
Thanks, Nanette.
Yes, good night.
Take care.